Happy New Year to everyone. Hope you and your family are doing well. Welcome to the first national webinar from Team Mire Asset in 2021. I'm very pleased to have the entire fixed income team join me in today's call. Let me introduce them to all of you. We have Mr. Mahendra Jajoo, CIO Fixed Income, who manages all our fixed income strategies and has been associated with us for more than 3.5 years. Welcome, Mr. Jajoo.
Thank you very much, and I wish everyone a very happy New Year and welcome you all to our webinar today. Thank you.
Joining Mr. Jajoo is Abhishek Iyer, who manages fixed income dealing for us, and he also manages our overnight fund and co-manages the liquid fund along with Mr. Mahendra Jajoo.
Good evening, everyone, and wish you all a happy New Year.
Aspects on the economy and the credit part of the fixed income part joining us in today's discussion as well. So welcome Kunal
Thank
and
you,
Kruti.
everyone. Thanks for joining us on this call.
So thanks everyone. I think so what we want to start today is a interactive discussion where we talk about how markets have behaved in 2020 and the outlook for 2021. 2020 turned out to be amongst the most unpredictable years beyond anyone's imagination. It's difficult to imagine countries being locked down for so many months. However, in this very challenging environment, markets have done exceedingly well. Before we start today's session, let me ask Mr. Jajoo to share what are the key learnings he felt 2020 taught all of us. So over to you, Mr. Jajoo.
Thank you, Evo, and welcome to everyone once again. I'm particularly happy today to be here with you with my team, three key members of our team. When we look back at 2020, it was obviously an extraordinary year. And if there is one term that we kept hearing from every So we learned a different way of doing many things, and we talked about the new normal. But there is one thing that 2020 taught us was actually the reinforcement of a very profound representation to make this point. As you can see on the screen, that we have on the left-hand side something what I have described as a volatile asset class, and then on the right-hand side you can see a crow dropping stone one by one. I know that everyone can relate to the story of the untiring crow who finally fetched the water for himself. Now, when we talk about a lot of other asset classes, as you can see the paper plane flying all over the screen, what it indicates is that in volatile asset classes, markets can go up and go down in no time and by a huge margin. So if you are focused on other asset classes, there is a lot of volatility which you can take advantage of if you are very good in capturing volatility, or one can get whipsawed in those movements. But when it comes to fixed income, one has to work hard like a crow. We have to accumulate our returns stone by stone, so to say. There is no shortcut in the fixed income. Let me show you my next slide to further elaborate on this concept. You can see that we have on one left side the Nifty chart, and then you have the CRISIL Composite Bond Fund Index return represented by the blue line. Now, as all of us know that today the Nifty was at about 14,000 plus, I think somewhere around 14,400 or so. So Nifty has come to 14,000 over a period of 30 years of journey. But if you look at March, the Nifty was at 7,000. And then whenever we interact with people on the fixed income side, invariably, the only question I get asked is, what is your view on interest rate? Where do you think interest rates are going? We will invest when we think interest rates are going to go down. Everybody wants to take a market call on the fixed income side. But if you look at Nifty in 30 years, it traveled to a level of 14,000. But in March itself, it was at 7,000. So even if you missed investing in the past, or if one is very good with dealing with volatility, one could have made up for the not taking exposure to Nifty in the last 30 years. In the last 6 months, he could have captured 50% of it. Every year we get that kind of volatility. But if you look at the fixed income, you look at how smoothly the blue chart is going up. And specifically, if you look at the lockdown period when the Nifty fell, and this is not the first time this kind of movement happened, just look at how small the drop is in the fixed income chart. So the point I'm trying to make is that we spend too much time trying to understand where the interest rates are going to go up in the next 6 months. And we need to rather focus like the crow, build our portfolio year by year, year by year. You can't make up 50% of the 30-year journey in fixed income by taking an interest rate call. So that is the point I wanted to make about 2020. 2020 has once again reinforced in fixed income, the only way to get good long-term sustained return is to have an asset allocation approach. And if one is very smart with volatility, if one is very smart to take market calls, maybe that is far more effective in other asset classes like equity or commodities or gold. But in fixed income, the only way to make long-term good wealth accumulation is to go stone by stone. Thank you so much. I think that is my biggest learning from 2020. There is a new normal in every other space of life. But as far as the fixed income is concerned, it reinforces the point that you have to invest every day and invest for long term with an asset allocation approach.
So thanks, Mr. Jajoo, for sharing this insights. I think so. What you clearly have highlighted is, the old story that patience, always pays off. And I think so. This chart is an eye opener to everyone that how, fixed income has really been able to, keep pace with Nifty in spite of, investing for long periods without, having the volatility of the asset class which equity has given.
So, Vaibhav, I just want to make one more point that these two are on different scales. So, it doesn't mean that the fixed income will do as well as equity. Obviously, equity gives higher return, and that's why we have given the CAGR return Nifty 12%. But long-term return of CRISIL bond fund index is very good. The other point we need to understand is the benefit of diversification of the portfolio. As you can see, the volatility in fixed income is next to nothing compared to the other volatile asset classes. So a good blend of fixed income as a portfolio allocation also gives a lot of stability to the portfolio. And this is the stability of the portfolio, which then allows us to take advantage of the volatility in other asset classes. Thank you.
Thanks, Mr. Jajoo. I think so. This is a very important point of how fixed income necessarily needs to be part of asset allocation for any client. So for today's discussion, we have a question and answer format. I'm going to ask the esteemed panel here a few questions, which are the most frequently asked questions from our partners. And then we'll open the floor for specific questions from our partners. My request to all partners is we have a question box in today's call, and you can post your questions. But as I mentioned, we would just like you to hang to those questions till we finish the points that the team here wants to present. Now, let me start with the first question. Is heading into 2020, India was already in a very tricky situation, where the inflation was rising, there were concerns on the fiscal deficit, and the growth was slowing down. Can you share a recap of key macroeconomic indicators and how the debt markets behaved in 2020?
Thank you, Vaibhav. Let me start with taking a stock of the current macro environment. Let me just describe what are the key variables as far as the interest rates are concerned. So we know that there are two parts in which we analyze the fixed income, the global environment and the domestic environment. So as far as the domestic markets are concerned, the obvious indicators like inflation, GDP growth, liquidity, etc., affect the interest rate environment. And in case of global, we believe that the central bank policy, growth outlook, and the geopolitical scenario are important. Why we need to look at the global and domestic environment separately is because a country with a current account deficit is hugely dependent on the global capital flows. Therefore, you go back to the history, and every time there has been turbulence in our market was originating in the global environment, whether it was in 2018, 13, 2008, or before that. Let me just now shift to a more formal assessment of the current macro environment. Let us look at the current environment. The domestic macro environment right now is one where there is a strong economic recovery underway after the COVID-induced disruption in the earlier part of the year. Now, if you look at the current environment as far as the COVID is concerned, there is a significant flattening of the COVID curve after peaking at about 1 lakh new cases per day in September. Now we are registering about just below 20,000 cases per day. And the cumulative case count, which had hit a peak of about 10 lakhs in September, now the active cases outstanding are below 2.5 lakhs. So there is a huge flattening of the curve at a very quick pace that we have seen in the last 3 months. And that has happened in spite of the festive season, number of elections in different states, and with the onset of winter, especially in the northern part of India. So these are the three factors which experts thought that could further spread infection, but India has been able to overcome. So I think today we are in a very strong and optimistic situation as far as the COVID is concerned, which was the reason there was a turbulence in 2020. And now we already have 2 vaccines approved in India. So there is a further reason to be optimistic on quick recovery of the COVID situation. Now, if you look at the GDP scenario in the first quarter of the 2021, which is the period of April to June, there was a complete collapse in the GDP growth. Obviously, because of the lockdown, there was a 24% contraction in quarter one. The quarter one saw a very smart recovery, and the contraction was only 7.5% because the unlocking had started. And then the growth in the current quarter, that is the 3-month period ending December 20, our view is that the growth has already surpassed in that of December 2019. So, which means for the current quarter, we should be looking for a positive growth. And yesterday, the advanced estimate from the National Statistic Office for FY21 was released. That is at around minus 7.7%. Now, if you look at the 24% contraction in the first quarter, 7.5% contraction in the second quarter, and then the overall year estimate of 7.7, it is very clear that the NSO is also expecting the economy to have fully recovered and register a positive growth in the next quarter, which is January to March. Coming to the inflation situation, there isn't very much of a good news that I can share about inflation. Inflation hit a high of 7.61% in November, and then it started easing. It came to about 6.93 in December, and in January inflation number, which is due to be released next week, we are expecting the inflation to have come down to 5%. However, and this surge in the inflation was least expected because with a contracting economy, people thought that maybe the inflation should not have gone up, but this has been attributed to disruption in supply chain because of the lockdown and volatile food and vegetable component. But I think the surge in the core inflation also from about 4% to 5.5% in December does not give us good comfort. We believe that inflation will continue to be elevated in the next year also, and I will come to that in a little more detail subsequently. But for now, let me switch to the monetary policy situation. Now, as you know, that the global central banks are currently following an extremely loose monetary policy, and RBI also is currently in a very accommodative mode. One would rather say that given the disruption caused by the COVID and the collapse in the economic growth that happened because of that, RBI is currently in an emergency mood. They have completely ignored inflation surge, which they would have not have done in a normal situation. And even though the inflation has gone up, the Reserve Bank has been able to retain an accommodative stance, in our view, largely also because we saw huge inflow from the global players like FPI and FDI during this period, almost $60 billion of flow in the second half of the 2020. That led to a huge surplus liquidity in the system, and that also helped the interest rates to remain on the lower side. And finally, on the fiscal deficit front, in the current year, the government is likely to post a fiscal deficit of 8% to the GDP, which is acceptable given the fact that the year was a very, very difficult year with the collapse of the economy and the need to support the poorer section and the MSME segment of the economy. But even for fiscal 22, next year also we believe that the fiscal deficit will be on the higher side. There is repeated noise from the government that once the COVID situation stabilizes, they would then go on a more aggressive fiscal stimulus package. So I think broadly, just to recap what I have said, that the Reserve Bank has a lot of extra elbow room to continue pursuing a loose monetary policy in spite of high inflation because of the excess liquidity and the benign global environment. We have a very difficult situation to handle on the inflation side. So this is how we are poised. I will now request Kruti to also give you a little more detail on the different data points that we saw during 2020. So over to you, Kruti.
Thank you. Good evening, everyone, and I hope everyone is doing well. So just getting into the data points of 2020 and how we were looking. So if we just see, the main point has been COVID scenario in India, and this is how the graph looks like, new confirmed cases. And the yellow line gives you 3-day moving average. So we see that since the economy started opening up, March we went into the full lockdown, and in tranches we were opening up. It was only towards the end of the May that we started opening up in a bit, where we saw restaurants and flights resuming. And thereon we see that the cases increasingly went up. Like Jajoo sir mentioned before, also September was the time when we peaked out with the new confirmed cases and active cases, and thereafter we've seen that we have come down. Now the cases have been daily reported below 20,000. An average comes to 16 to 17,000 daily. That is in spite of the economy running fully and completely, everything allowed. Coming to CPI. So we see that CPI has shot up, obviously, and March was a level where we were at around 5.5. Thereafter, because of the shutdown in economy and logistic issues, we had seen that the CPI had gone up. So most of this is attributed to food inflation, which is 45% of the basket of the CPI. And because of the logistic problems, they said that the food inflation had inched up. Last month was the only month where we saw a drop at 6.93%. Otherwise, throughout we had seen the inflation being between 6.5% to 7%. But on the other side, if we go to see, your core inflation has also gone up from 3.5 to 5.51. And reason being that there has been a rise in your education costs. Obviously, there's a massive healthcare which has risen up during these months, and also some of it is attributed to transportation costs becoming more heavy during these times. So this is why the core inflation has been sticky, and we don't expect core inflation to come down much, but definitely on the CPI side, we expect it to come down because the volatile part of the inflation will come down. Coming on to the commodities, we see over 3 months, 6 months, 9 months, and 1 year. So if we see Brent crude, we had seen that it had gone to the lowest levels. But now we are seeing that the momentum is getting losing the way in gold and silver and platinum. If we see the industrial, we see that most of the commodities are seeing rise year-on-year basis. Iron ore and steel particularly has seen a higher rise because of the ban that the Chinese ban that has happened on the Australian imports. Therefore, and China being one of the economies which has picked up the most, the demand for steel remains highest over there, and because of the higher demand and lower supply, Australia being one of the largest supplier, the steel prices have just shot up to the levels at 70%, 75%, and this has also affected Indian steel prices so far. Agricultural goods also has seen the same trend. So overall, we are seeing that the commodity prices have recovered a lot from the previous year's levels. Towards the fiscal deficit, the budgeted deficit was obviously 3.5% for FY21, but that was just before the COVID broke out, and now the scenario looks much more different, wherein we are seeing that the revenues are collected so far. The November ending number is only 40%, whereas your expenditure stands at 62%. Majorly, the expenditure remains still with the on the revenue expenditure side, and the capital expenditure remains on the lower side given the situation currently. So, based on this, we expect that the market consensus is that the fiscal deficit should be around 8% this year. On the CAD situation, we have seen that there has been 2 quarters of surplus, which is a rare situation, being India is an oil import country. But if we just see the last 2 quarters, we have really gone down on the oil imports, A, because the prices have gone down drastically, and B, there hasn't been much of the mobility and use. So if we see for Q1 and Q2, the approximate oil imports had been around $15 to $20 billion compared to what it used to be 30 to 35 every quarter. So that is one of the reasons why we are looking so good on CAD. But this number, as we import more and it as we open more, may see a neutral level this year. Going on to GDP, Q1 has been a contraction of 23.9%, and we recovered fairly well in Q2. That was mainly because of revival in manufacturing, which is around 15% of your GVA basket. There was the agriculture has been good in both the quarters, and also there has been a push from government expenditure, which helped in the revival of the GDP a bit. But mainly it was because of the manufacturing that had pushed the GDP number in Q2. And if we see the credit growth, we have seen, so an observation over here we would make that in December 2018 is when the credit growth peaked out. This is also a period where the IL&FS crisis happened, and thereafter we are seeing that the credit growth had seen dropping. Still, before the crisis, the credit growth was fairly at 12 to 14%. But this year we have seen barely credit growth of 5.5% to now picking up somewhere around 6%. But since March till now, we have only seen it at 5.5%. So that's not regained as yet. And based on these developments, we have seen that the GSEC demand has been there. And if we just notice in the period wise, 1 year and 3 year GSEC and AAA is somewhere where you see the movement the most. So 1 year GSEC has dropped by around 200 basis points. Similarly, for 3 year GSEC, around 200 basis points. And you see your 1 year AAA dropping by 251 basis points and 3 year at 239 basis points. Reason for there are a couple of reasons to this. Because the RBI after the pandemic, we saw that RBI had announced the policy before the actual date of the announcement. So it was very hard to predict the movement of RBI at that point of time. Also, 3 year in that, and there was seen a lot of demand in those papers at that point of time. So there was a drastic drop in yields at that moment. So overall, we've seen from the previous year till now, the spreads have compressed significantly from the levels of previously being 70 to 100 basis points. And just on a global, if we see the Fed, when the pandemic broke out, Fed took an immediate action. So its first reaction was cutting down the rates by 50 basis points. But as the situation seemed to be worsened out, they went in for 100 basis points and dropping it right to zero. Addition to that, they had given a lot of quantitative easing, and Fed balance sheet has pumped up so much that from the year beginning at around $4 trillion balance sheet, now it is around $7.3 trillion. So it has nearly increased its balance sheet size by 85%. So that was an action which was taken by Fed. On the domestic side also, we had seen a lot of support by RBI. So initially there was a rate cut in we have cut 150 basis OMOs and TLTROs to keep the liquidity supported and the market supported, with which we've seen the levels coming down from 7.5 to now 5.85 is the range that is there. And just on liquidity, so as action of RBI, slow credit growth, the disbursements not happening, and market intervention by RBI, we have seen that the liquidity has been continuously in surplus. This is the first time, obviously, after the demonetization that we've seen surplus liquidity, but even after demonetization, the liquid not so long and not at these levels, but we still see that the liquidity very soon. So this is on the brief domestic development in 2020. Over to you, Weber.
So thanks for your very how 2020 panned out. I think so. The biggest question that must be there in all the partners and investors' mind is how will 2021 look like? So my next question to the fixed income team in 2020, which was an unexpected year. What are the signals that you will look out from the RBI, and how do you think debt markets will behave in the year 2021?
So thank you, Weber. We took a little bit of time to review 2020 in detail because the outlook to 21 is completely linked to how, because of its extraordinary situation, 2020 has led RBI into a very emergency kind of a mode, firefighting mode. I would like to share my slide once again, and let's look at what our thoughts about 2021 is. So decisive guidance from the Monetary Policy Committee to keep the rates low till at least June 2021. Now, I talked about the COVID situation and I talked about the economic recovery in some detail because the Reserve Bank took extraordinary steps of cutting rates very aggressively because of the COVID disruption, which led to economic fallout. Now, we have seen in the earlier section how the COVID situation gives us a lot of comfort and confidence as to how the situation should continue to improve. And the high frequency data that we are getting, whether it is the Google mobility, whether it is the mall footfall, whether it is the airline travel, everything is suggesting that the economic recovery is at a very strong pace. And the most important part is that even during the peak of the lockdown, the rural economy continued to do well. And therefore, I think there is reason to feel optimistic about the economic recovery. The government of India has also indicated that once the COVID situation is under control and the government feels confident, it is at that point that the government will loosen its purse strings and go for a fiscal stimulus of a more aggressive nature. Now we are at this stage where the economic recovery is strong and the COVID situation is coming under control. So therefore, we expect the FY22 budget, which will be announced on 1st of February, to again go for a very strong fiscal stimulus and possibly, and there are some, more outlier estimates that the government may still have another year of 8% fiscal deficit, which will be very, very negative for fixed income. And finally, the inflation is likely to remain very, very elevated. The highest consensus trade for 2021 globally is commodities because of the weaker dollar and the excess liquidity in the system and because of the expectations of the recovery of the economy globally. Then we have seen in India, the auto companies, which even before COVID were witnessing huge fall in sales. Now they are announcing price hike. We know that the Maruti now has a waiting period of 3 months and more. Even companies like Hyundai are announcing price hike. We have seen a lot of consumer durable companies announce price hike. And that is when the economy is still recovering. We are seeing a huge demand surge. We have seen the steel companies announce a price hike 5 times in the last 1 month alone. The NMDC has increased the lump iron ore price by 10% just yesterday. So there is every indication that inflation will continue to be a challenge. Therefore, just to summarize, in conclusion of what we have discussed, we expect RBI to remain accommodative, economy to recover, and inflation to go high in the next year. Although MPC at its December meeting made 2 very important changes in its guidance. Till every monetary policy before the December policy, that is till October, RBI said that there is a room for rates to be cut further and that the inflation is transient in nature, driven by the highly volatile food, vegetable prices and supplies disruption, but they're expecting the inflation to come down. Now in the December policy, we saw 2 very significant changes in the RBI's language. First is they said that the inflation projections are being revised up significantly. So till October, their expectation of inflation for the second half of the FY21 was around 5%, 4.5 to 5.4% band. But in December policy, they revised the inflation forecast for the current quarter to 6.8% and for the January-March 21 period to 5.8%. Now that is almost 100 to 150 basis points of revision in forecast. And then RBI said that the room for any further rate cuts is constrained because of the higher inflation. And why? Because they said that even though inflation may fall in December, and which is what we said, maybe it falls to about 5%, but that fall will now be transient and they expect the inflationary pressures to continue to build up. In that backdrop, I think one can say with a reasonable amount of confidence that maybe the rate cuts are not going to be there anymore. Now, in the current week, we have seen a very significant development that the US 10-year yield has breached a very critical level of 1%. Now, This is the highest level at which the 10-year US Treasury is trading after the gap of 9 months, that is from the time the COVID situation broke out. Now, why in US the rates have gone up is because of the new president from the Democratic Party, and people believe that the new president will go for a very high fiscal deficit, and that could therefore lead to much larger supplies and so on. And the other reason is that the Fed minutes were also announced on the same day, where the Fed did not extend the maturity of securities that it was buying under the quantitative easing, which market was expecting. So there was a disappointment on that front. But for the first time, we have seen follow-up selling. So after hitting 1% yesterday, it went to 1.08%. So that is a negative development. And then, therefore, a lot will depend on how RBI looks at the situation. That is for the first half of the year. And then once we get the indications on monsoon, whether monsoon is going to be normal or deficient or surplus, a lot of clue will come from there. Therefore, what does it mean in terms of the market action? We believe that the interest rates will remain range bound for at least the first half of the year, because at this point, if we look at the fundamentals which are on the left hand side, the conclusion chart, if you look at the fundamentals, inflation going high, fiscal deficit likely to remain high, the global environment isn't looking that supportive because of the impact on the 10-year US yield for now. However, the global central banks are extremely supportive of a loose interest rate policy. They are in a very miserable situation, because in much of Europe and Japan, the inflation is nowhere close to their target of 2%. In fact, if you look at the numbers of inflation released in Europe, Germany, France, Spain, everywhere the inflation is close to zero or negative. Same thing with Japan. Therefore, I think that RBI will continue to get a tailwind or support from a benign global environment and extraordinarily excess liquidity in the global setup. That gives the Reserve Bank a little bit of extra room, extra elbow room to maintain low interest rates. Therefore, in our view, the markets does not have the tailwind of the fundamentals to take the rates lower from the current already record low interest rates. However, this continued intervention by the Reserve Bank through open market operations, through Operation Twist, and through other monetary policy measures, that any meaningful increase in the interest rates will be arrested or kept by the Reserve Bank action. So you are looking at a pretty much no-brainer situation of a range-bound interest rate, and the obvious trade in that environment is to buy at the resistance level, and support level is where you book profit, which means if the interest rates go up and hit the resistance level, at that time you need to buy incremental position. And when there is RBI intervention and the market again gets a little bit of positive momentum, then at support level you sell. So that kind of tactical positioning is, in my view, likely to prevail for the first half of the year. And then, as I said, in the second half of the year, we have to see how the monsoon outlook evolves, and then how the borrowings are handled by the current system, because as the economy grows further, the current excess liquidity which is parked with the Reserve Bank will flow into the system through the working capital requirement from the corporate sector, and that will have two impact. One is that the demand will fuel price rise, which will lead to inflation, and that liquidity coming down to the system will have its own multiplier effect on inflation. So in the second half of the year, we are expecting the interest rates to inch higher. That, I think, is the broad assessment as far as the 21 is concerned.
Thanks, Mr. Jajoo, for sharing that insights on how 2021 may look like. I think the next question that I want to ask is, and I think so that's a question which is paramount in the case of many investors, is that we've seen interest rates have fallen a lot over the last 2 years. And like Kruti mentioned, we've seen a very sharp fall in the interest rates. Now, in most cases, FD rates and debt, mutual fund YTMs have gone down a lot as well. Now, in this scenario, how should investors approach investing in fixed income instruments? Is what we would like to take your guidance from.
So, Vaibhav, ideally, I would like to go back to my first slide, which is what I said, that in fixed income, we have to act like the hard-working crow, and year by year, we have to earn our accrual and get a little bit of capital gains. You look at the history of the debt funds, over 83-year rolling period, the bond funds have given close to 9-10% return. Even the long-term return of the bond funds is in the 9-10% band. There are years when interest rates go up, but I think the investors need to look at the fixed income and debt fund investing in two parts. Investors who have long-term investment horizon, who have the ability to invest and remain invested through one complete interest rate cycle. I think they should just not bother about the interest rate, volatility. As I explained in my first slide, if people have to take a market call, I think that is far more rewarding on the equity side or on the commodities side. In my view, if suppose interest rates go up in the second half of the year, the fund managers will get the opportunity to invest the new money at a higher level. And then, in the next 1 year or 1.5 years, when again the interest rate environment becomes supportive, there will be capital gains. And that's how the 3-year period, typically for a complete interest rate cycle, becomes very rewarding for the investors. So I feel that people who have taken the asset allocation approach to fixed income, who are investing for long term, I think for them, the dynamic bond fund, the banking PSU fund, these are the two best suited fund. And I don't want to even get into a debate as to what happens to a fixed deposit or a tax-free bond or any other debt option, because I am of a very clear opinion that there is no product which matches the debt fund return even closely over long term. So those products are for people who are fearful, who are extra careful, who think too much. But if you look at the risk factor in the debt funds, there is only one risk in debt funds. That is if there is a credit default. And you know that for the last 4 years, every single such interaction which I had the opportunity to participate in, I have said, market risk is temporary, credit risk is permanent. If you get trapped into an interest rate volatility situation, doesn't matter as long as you have enough, horizon to remain invested through one interest rate cycle. If you happen to encounter a credit accident, then under the Indian system, the recovery is extremely challenging. And now we know there are cases where the recovery has happened, but the investors are not able to get the money for 30 different legal and technical challenges. So I think the important thing is to avoid a credit, crisis or a credit event. Now, apart from that, I don't see a challenge to any debt fund by any of these products. Again, I will understand that some of this may be too impractical or theoretical for some of the investors who would still like to take an interest rate call and all that. I think the second product which I particularly like right now is the low duration fund, because as I said, we believe that in the second half of the year, the interest rates are likely to go up. So a low duration fund, which in our case is the Mirai Asset Savings Fund, typically is investing up to 1 year of maximum duration portfolio. So therefore, in the next 6 months, 8 months, 10 months, when interest rate, if they go up, a lot of maturities will come, which will be then invested at the higher yield. And the interest rate risk is also lower because the maximum duration is 1 year. So by the time interest rates go up, there will be a lot of reinvestment opportunities, which is why I believe the best solution to the apprehension of interest rates going up right now is to put money into the Mirai Asset Savings Fund. And then we have this beautiful category which is called short duration category, and we follow a flexible investment strategy where when we think that interest rates are going up, we reduce the duration, and when we think that interest rates are going down, we increase the duration. So let's say in case of short duration fund, the allowed range of duration for the portfolio is 1 to 3 years. So when we think that interest rates are going to go up, we bring down the duration to 1 year, which allows a reasonable degree of protection. And then when the interest rates begin to soften again, you take the duration closer to 3 years, it allows you to participate. We believe in a very conservative credit positioning. Now, therefore, in case of short-term fund, people can come with 18 to 24 months of investment horizon. I would just want to close with saying that we are fund managers, we are guided by the SEBI guidelines. So whatever I am saying now or before or after this, everyone should read that in line with the disclosures and disclaimers which we have put on our website, in our scheme offer documents, etc. They should consider the risk disclosures and disclaimers along with all the comments that I have made today.
Sure. Thanks, Mr. Jajoo, for telling different options that investors can look at for investing in this kind of market scenario. One last question before we take, I think so we're already seeing about 10-15 questions posted from our participants. One last question from my side is, in last year we saw Mirai launch few products and strengthening their fixed income basket. Can you share some ideas on what we are planning to do in 2021 and trying to strengthen the fixed income basket for investors?
So as you can see, we have the whole fixed income team with me today. So the idea was to give you a flavor of how strong processes and systems we have. We have dedicated leaders for the dealing side, for the credit side, and for the market and portfolio analysis side. And in the current year, we have added 2 products into our basket, and we are still in the process of building our business. And ideally, I think Swaroop sir will talk about this, but I will just still take this opportunity to say we will look to add the corporate bond fund in our portfolio at this point, because that is one category which is again very safe, very competitive in terms of the return, and it gives a very wide range of options because we have good spreads on the government bonds in the corporate segment. So there are now so many strong, good, fundamentally strong companies in the AAA, AA plus space, and that is one segment where we are going to introduce our next product. As you know, that all the other products that we have introduced in line with the market, situation and in terms of the investors matching. So I think this year corporate bond fund is a product that will fit in very well.
So thanks, Mr. Jajoo, for your response. What we will do is we will take questions from participants in today's webinar as well as questions from
mutual fund investments are subject to market risks. Read all scheme related documents carefully.